Taking a look at the currency market now with Nomvuyo Guma, Macroeconomic Strategist over at Standard Bank. Nomvuyo, thanks so much for joining us today. So the local unit tumbling to its lowest level since May 2009 yesterday, hitting 855.70 against the dollar. And now traders saying that we're potentially eyeing that key psychological level of 9 to the dollar. What's your view on where to from here on out?
Alishia, the rand really came under pressure yesterday, as you mentioned, and the barrage of bad data was simply relentless. We had a resurgence of fears in the eurozone after a failed auction of German bonds, and of course Germany is considered the gold standard of safety as far as bonds are concerned. So that reignited fears that the eurozone crisis has spread right to the core of the euro area and hit the most stable country, or what was considered to be until now the most stable country, which would be Germany. So that obviously wasn't good for markets. Then we also had some bad confidence data out of EU, also some unpleasant data out of the US, a rise in jobless claims, a decline in durable goods orders. So I think the rand really was hit on all sides yesterday, and locally we also had a rise in CPI, we had depressed BCI level, business confidence levels. So the rand really came under pressure from all directions, and we don't think that that kind of depreciation that we saw yesterday is going to be sustained. It's already come back off its worst levels and should be in for a brief period of consolidation, but as ever remains vulnerable to changes in global sentiment, and at the moment things seem to be still quite risk off. So I wouldn't discount the possibility that it could head to 9 rand, but that's not our base case scenario. We probably think it'll continue to trade at these current levels for a little while longer, and then might depreciate subject to what happens in the eurozone or even in the US.
For now, are you still targeting that 820 level by year end on your end?
We're still targeting 820 for year end, but of course the average is likely to be much higher than that. We do expect the rand to retrace at the end of the year, but that is based on a view that there's going to be an imminent solution to the eurozone crisis. As it stands, there isn't, and it does seem that things are worsening there. So certainly those forecasts are vulnerable to a revision.
Of course, the weaker unit that we've seen come through posing an upside risk to inflation. We already saw that CPI number, as you said yesterday, come in at 6%, not much higher than had been expected, but certainly worse than expected nevertheless. What did you make of that movement that came through, and what are you anticipating for PPI numbers today?
Well, as far as the CPI was concerned, we did think that the risk lay to the upside, so we weren't entirely surprised then that it did come in at about 6%. We see inflation now breaching the upper target limit in November, and we think it's going to remain out of range for most of 2012. We only see it coming back down below 6% on a sustained basis in Q4 of next year. So it's likely to be quite a steep inflation trajectory than we were forecasting a few months ago, and that of course is then going to play into rate expectations or interest rate settings. We now see the repo rate on hold all through next year, so that certainly would have been a change in our view based on the CPI data yesterday. As far as the PPI is concerned, also a strong upward trajectory that we're seeing in PPI. We see it coming in again in double digits for October, but very close. I think the market is anticipating 11%, and we would be in line with that view.